Awesome. All right. So, welcome to this session. This session has to do with mortgage notes. This is actually an introduction to mortgage notes. And so, if you remember, one of the places where we left off, as we left off talking about real estate terms and their creativity. We also talked about how you can buy properties with little to no money down, with little to no credit. You can use a bank or you can be the bank, which is a perfect segue into mortgage notes. I don't know if you remember this. You may have to go back and look through some of the previously recorded trainings, but when we went through talking about wraparound mortgages, one of the powers of using a wraparound mortgage, if you yourself are actually selling a property that way, as I don't know if you really thought about it this way, but it's really like you're creating money out of thin air. Think about that for a second. I mean, if you had the machine, if you had the ability to print money anytime you wanted to, how cool would that be? Well, in a sense, that's kind of what you have, because obviously if, let's just say that I picked up something like a calculator, right? If I just picked up a calculator that I didn't really need all that much and I just gave it to you and I said, hey, I'm giving you this calculator, you can owe me $10 or $15. Yeah, okay, so maybe I got you to owe me $10 or $15, but honestly, that's not going to change my life if I get $15 from you, right? But when you have the knowledge of being able to acquire houses, buildings, really simply, and then turn around and have someone owe you to be able to pay you for those, the amounts of money that they would owe you, we're talking about the denominations of thousands, 5,000, 10,000, 15, 20,000 more. Those are the kind of values that could change your life. But what I'm saying on top of that is that with mortgages, with houses, you can also add interest. And interest is the game changer, because 10,000, as you know, with interest could be 20,000 someone is owing to you. So it's really powerful, because if you grasp what we did in that wraparound mortgage, we had someone owe us money, and then on top of that, we charged interest, even though we never loaned them a thing. So someone might say, okay, that's powerful from an income stream standpoint, but Rob, how often do I get a chance to turn an income stream into cash, or a mortgage note into cash? And so it's really, really important that you understand this concept that we're going through tonight first, so that you can understand that mortgage notes can be sold for cash. They can be purchased. They can be traded. They all sorts of them. I mean, imagination, it's just limited by the imagination. It's pretty powerful. So in today's discussion, some of you are new on this webinar, by the way, so you probably don't remember the framework that we started off with. One of the things that we always did with each session is we always told you what we covered last, what we're going to cover, then we'll cover the information, and then we summarize talking about what we just covered. So I already kind of gave you an idea where we left off. So what we're going to be talking about today, in today's discussion, we're going to talk about how you can owe someone a mortgage, or someone can owe you for real estate purposes. These are called mortgage notes, obviously, but they're really like IOUs. And the note industry isn't just for mortgages. It can be for the car industry. It can be for pretty much any business, by the way. In businesses, it's called factoring. When businesses have some sort of receivables that they're used to receiving, but they need cash, there's something called factoring, where they can sell those receivables. One of the examples that I used talking to Carmen's a property manager. As I said, my wife used to be in the carpet industry, carpet cleaning. She used to do carpet cleaning for apartments. Well, occasionally, and you guys wouldn't know this unless you're in a business like Carmen, the apartments can rack up a sizable carpet cleaning bill. They would typically owe my wife, $10,000, $20,000, $10,000 or $20,000 just for cleaning carpets and floods and different things. But my point is, occasionally my wife would find herself in a situation where an apartment complex hadn't paid her for more than a month, maybe even 2 months or more. And so at one point I told her about, sort of note buying, factoring, where she could sell those receivables that IOU to a debt collector, and then they would pay her cash. She can get some cash. She wouldn't get the full amount. And she said, that sounds interesting, but the only problem is for politics reason, I wouldn't want that debt collector going out the apartment complex. I'd lose the whole contract altogether. But you see my point, though, is the fact that she could still, it's not a mortgage note, but it's very similar. Someone could offer to purchase an income stream stream from a business, and then they make money because they bought that income stream at a discount. So that's really what we're talking about. It's not just mortgage notes. Just grab the concept, okay? So what we're also going to be covering, of course, today is an introduction. So we're not going to get too deep. This is a very deep subject, but I'm going to start at the basic. We're going to talk about how to calculate interest. We're going to talk about how to calculate payments, principal. I should be putting some of this stuff on the screen because I know whenever you're just hearing me talk, you always wonder if your screen is working properly. So, so let me just type something on the screen here. So that way you know at least that I am alive over here. All right, let's pull the toolbar back out. Okay, so I mentioned we're going to be talking about how to calculate interest. We're going to be talking about how to calculate payments. We're going to go through what's called a present value. Present value is similar to a loan balance. It's really like it can be the loan balance. It's just talking about, since we're talking about purchasing notes, we're talking about what would be the value. What would you have to come up with cash if you wanted to get a certain rate of return, okay? So principal value, and we're going to talk about the duration. That's the term of the loan, how long a period of time is for the loan. We're going to show you how to calculate all of that on a mortgage note, okay? Yep. So this is what we're going to learn today. This is what we're going to go through. We're also going to talk about how to determine how much time, right? So we're also going to, let me minimize that. Why is that thing constantly in my way? So we're also going to talk about how to calculate how much time is left on a mortgage note. Not how much time, how much principal balance. How much principal balance is left on a mortgage note or balloon. And we'll talk more about balloons here in a minute. Okay, and let's see. Of course, we're going to cover different calculator functions. That's one of the things we're going to talk about also. Oh, I see why. I see why I keep losing this thing. Okay. Different calculator functions. All right, so that's something else we're going to cover. Okay, so these are some of the things we're going to cover today, so that way you can follow along. And by the way, I'm going to strongly suggest that if you don't have a financial calculator, that you get a financial calculator if you're going to be a serious real estate investor. I used to give my class a hard time when I used to be on the road doing seminars. I used to give my class a hard time about coming to our 3-day training, and people wouldn't bring a calculator. I'm like, how did you come to learn about finance and did not bring a calculator? So I'm not going to absolve you of getting the same criticism. You guys have been with us, some of you guys have been with us for several months now. So if you're going to be serious about being a real estate investor, you're going to need a financial calculator, not just want one. You should understand mortgages. You should understand payments. You should understand durations, because this is the intricacies of, this is the reason why real estate investors make more money than most people, because they study the stuff that most people don't want to study, right? How can a person pay 2 times what for their house, the amount that they should pay because of interest, and not even study why that is? They're paying twice. A $200,000 house will cost them $400,000, and yet people never study how they can save on that, or why that's the reason, why that's the cause. Okay, all right. So first, let's clear my screen here. Let's start there. Don't save. Okay. So let me introduce you to my calculator. Okay, so this calculator that I have happens to be a Texas Instruments BA2 Plus. You can see it right there. It says BA2 Plus, Texas Instruments Financial Calculator. Financial Calculator has on it, it has these keys here that go across it. These keys in gray that are light, they are called TVM keys. TVM stands for time value of money. As a matter of fact, if you look right there where it's yellow, it says clear TVM. Again, that's if you need to clear the values in these time value of money keys. Now there are 5 keys, as you can see here, that go across the center of the calculator. We will not focus on this last one here. This FV key stands for future value. So if you wanted to know what the value of something in the future, that's what you would use to calculate that. But we're not at that point now, because this is we got to go through some basics for you to understand what this calculator does. Okay, so first, let me talk about, before I get into the functions of the calculator, let me just mention that in my calculator, my wife teases me about being a nerd because I have this calculator everywhere. Okay, obviously you're looking at this calculator on my desktop, so you at least know that I have it on my laptop, right, on my computer. But I also have the same app in my telephone. I have an Apple phone, so through the App Store I can download that same app and I can have it on my phone. But then I actually have a real physical calculator exactly like this. I know it's overkill. I just don't want to be without my calculator, because I never know when I'm talking to somebody and I'll need to calculate something like this. You'll see why I carry it so often. But again, I have the VA2 Business Analyst Plus calculator. I forget, because I've had them for so long, as to how much they cost. I think the physical one was probably $20 or so. I know one of the people on our team, Carmen, got the app last week or so. So for those of you who have access to the Apple Store, what's the word I'm looking for? The applications, something like that. Anyway, you can download it. I forget how much it costs. But there are different types of calculators. It doesn't have to be a Business Analyst Plus, but if you want to follow along with me, I suggest you get the same calculator. The calculators do things, they operate differently. Pretty much all of them have these same keys here. Let me talk about what these keys are from left to right, first of all. This first key here, the N, it stands for number. Okay, a number is where we're going to enter all of our durations. So the duration of a loan, it's always entered in denominations of months. So if you typically when we're talking about mortgages, we're talking about either a 30-year mortgage or a 15-year mortgage, right? You might see a 10-year mortgage, but most of the time it's either 15 or a 30-year mortgage. Well, here you're not going to enter 30 years or 15 or even 10. You're going to enter what that would mean in months. So, for instance, if you were going to enter a 30-year mortgage, right, what is 30 times 12, right? That's going to be 360, okay? So I'll come back to that, but I just wanted you to get an idea that that's how you would enter, that's what you would enter in the N, on the N key. Here, you can see it says I/Y. That stands for interest per year. So obviously when there's a mortgage, when someone's loaned someone some money, they're charging interest, some sort of annualized interest. And so this is where you would plug that amount. PV is the one that doesn't sound like it would make sense. PV stands for present value, and that's typically the loan balance. That's either the amount that was loaned to someone or the amount that is still outstanding after having loaned someone some money. Typically, at the very bottom here, you'll see there's a positive and negative key. Typically, when you're entering PV amounts, when you're entering them, you'll enter them negative. The reason why is because that's usually money that's loaned out to someone, or that's money leaving you. And then you got payment here, this final one, PMT. The way these keys are used is the calculator helps you to calculate, like if you have any three of these values, the calculator will help you to calculate the fourth. So sometimes you might know, what your loan balance is and the interest rate and for how long, but you don't know what kind of payment that represents. Sometimes you might have the payment and you know how much you borrowed, and maybe you even know the interest, but you don't know how long of a period that is. And you get the gist. So I'm going to show you how to do that. And what I was talking earlier about different calculators, there's a HP, Hewlett-Packard makes a pretty good calculator. So some people who are really, really serious about doing real estate or finance in general, you'll pretty commonly see an HP. I think 12C is a number that comes to mind, and they all handle their functions a little bit differently. So when I go through how to enter some of these values, depending upon what type of calculator you have, you may have to enter your values differently than I would normally. okay? All right, so let me make sure that was everything that I wanted to say on here. So let me give you an example of how you would enter some values. So I'm going to give you what I call a template. What I mean by template, there's going to be a set of numbers that I want you to get accustomed to entering into your calculator. So if ever your calculator gets out of sync, if ever your calculator doesn't add up something correctly, then you'll always be able to use this as a template to make sure the numbers add up correctly. Okay, so let me show you a couple of places, a couple of fixes if your calculator is to ever get out of sync. One fix, at least on this calculator, is you see this yellow key here. This is called a second function key. And that second function key, every place where you see it's yellow, that's what that second function key is for. Anytime you want to access any of those functions in yellow, you'd hit second function, and that lets you know that you are not using the function that is actually stated on the key, but what's stated in yellow. Okay, so if you needed to reset your calculator for some reason, the way you would do that would be second function here. I'll click that. Oh, I got to do it on my actual calculator. Sometimes I get thrown off because this is actually on my iPad. So you would hit the second function key, and then you would hit the reset button on the bottom, which is down here where it says positive and negative. You'd hit this key, and so notice it's got this reset. You would press equal, the equal, and then that makes some things zeroed out. That's one possible solution to clearing out something that may be, you may have some value somewhere that is throwing your calculations off. Let me tell you another thing that I see pretty commonly is, see right over here where it says IY, the interest per year? Well, right above that is PY. Okay, and so sometimes what I see people have in their calculator, and they didn't necessarily set it themselves. Who knows how they did it? They may have accidentally done it. The calculator may have come that way. But sometimes, let me show you what's in my calculator now, because this is the correct way. What you should have in your calculator, if I do second function and PY, you should have the number 12. What this is basically saying is the periods per year that the interest compounds. Okay, that's basically why it says PY, the periods per year that the interest compounds. So it should say 12 in your calculator. If you don't have 12 in your calculator, because sometimes I see people have 1, like for instance, let me press 1 here for a second. If I press 1 and then I hit enter, now you notice PY equals 1. If you have that, but you wouldn't know that you had it, some of your calculations are going to be a little bit off. Okay, so again, the way you fix that is if you need to change it to 12, then just hit 12 and go back, hit this enter button. Enter is right here at the top, by the way. See where my mouse is. Hit enter, and now it's changed to 12. And your calculations between the reset and between that, your calculations should be good. So I wanted to cover that because these are some of the quirks that I've noticed that you could run into and your calculations be off. All right, so let me go back to the template that I was describing. So I'm going to give you a template that you can always go back to just to make sure that your calculator is working fine, and then you can do more advanced stuff. So here's the template that we're going to use. All right, so let's always do our clear TVM key first, just to make sure that all our time value keys are clear. And the first thing we're going to enter is always enter the value first and then the key second. All right, the value first and the key second. So in this case, we're going to enter a 10-year loan. All right, so remember what I said, that you're not entering them in the number of years, you're entering it in the number of months. So just in case you're not comfortable, or I shouldn't say comfortable, just in case you don't remember how you do that, just think of the years. It's 10 years, right? Times 12. There's 12 months in a year. So that means a 10-year loan would be 120 months, right? So we're going to put 120, and then we're going to press the N key. And so now you can see N equals 120. Okay, great. The interest rate that we're going to use is we're going to use 10%. So we're going to enter the number 10, and then we're going to press the IY key. And so now your interest rate is 10%. Okay. Principal value, that's the amount that is being loaned. We're going to enter. Remember I said negative for the loan. We're going to enter 10,000. And then put negative. Put the number first and then the negative. Okay, 10,000, and I'm going to hit principal value. Okay, so we got a $10,000 loan. Okay, so now what I'm going to press is I'm going to, remember I said earlier that if you had any 3, you could calculate the 4th. Okay, so we just entered the duration, right, the number of months. We entered the interest rate. And we entered the amount of money that's loaned. And so what if we wanted to know what the payment is? So now, notice right in here in the upper left column, it says compute. We're going to hit that compute button, and we're going to press the value that we're trying to solve for, which is payment. So compute, payment, and you should get the answer $132.15. Okay? So so those numbers all across are the template. I keep referring to it as a template because when I was first learning this, I learned from this book, and I'll give you guys the book information as we get through this. But it always kind of used those as a fail-safe to start. Always go back to, so you can make sure your calculator is working, because you always know if you keep using it, you'll always know what the answer should be, and therefore you know if your calculator is working properly. Okay, so. But let's play around here for a minute. What I'm going to suggest you do, if this is your first time ever using a financial calculator, or especially this type of financial calculator, I'm going to suggest that you clear out any one of those columns. You know, put a 0. Put a 0 in principal value. Okay, you just did 0, and then hit compute again, and then press principal value. Okay. So see, it now says negative 10,000 is the amount that you borrowed. Put a 0 in the duration. Right? So you just made n a 0, go back and compute n, and then you should get 120 months. In other words, just keep doing that. You can do that with all across the board there, the interest rate, with the principal value, with the payment. I just want you to get comfortable pressing those numbers and clearing them out and different things. And obviously, if you want to clear out all of the value keys here, remember that time value of money, the way you get to that second function is you hit the second function key. I'll do that now, clear TVM, and then that clears everything, okay? So if I do a compute now, see, I got an error because there was nothing in there, okay? All right, so I want you to play around with that. Again, we're not going to cover a whole lot this time because I want you to get familiar with it, but let's do something else. So you may say, okay, well, what is this going to help me with? Okay, it's going to help you with understanding how to calculate all sorts of different scenarios regarding a mortgage. So one scenario might be is, let's just say that you purchased a house. You purchased a house over 9 years ago. Purchased a house 9 years ago for $30,000. It had a 30-year amortization at 6%. Okay. So the question would be, after 9 years, what would your loan balance be now? It was $30,000 at the time you purchased it, obviously, but after 9 years, what's your principal balance now? This is a pretty common question that most people have. Hey, I've been paying on my mortgage for a while. I wonder what my loan balance is. Now, the typical person who's not a real estate investor, how would they find that out? The only way they'd find that out is, 1, they'd call their mortgage company probably. 2, they'd have to track down one of their statements either online or a physical copy that they received in the mail. But the average person has no way of knowing how to calculate what their principal balance is at any given moment, right? So I'm going to show you how you can do that using a calculator. This same strategy that I'm getting ready to show you can also be used to calculate balloons. If you haven't purchased a property yet, then you don't really understand what a balloon is. Balloon just means, obviously, remember we said that a seller can finance you, and that way you don't have to go to the bank. You can actually make the seller your bank and pay them in monthly installments for the purchase of your property. Well, it might not surprise you that if you were purchasing a property from someone, everyone probably wouldn't want to carry out that purchase over 30 years, right? They probably say, okay, you know, I can make the payments low by amortizing it over 30 years, but I don't want to wait 30 years to get paid off. And so what some sellers might do is they may say, I'll give you a 30-year amortization, but in 5 years, in 10 years, you're going to have to pay me off. So that was what will be referred to as a 5-year balloon or a 10-year balloon. So the balloon and the future and the principal value that we're talking about here in this example, they're really the same thing. The the present value and the balloon is really the same thing. The only difference is time, right? Whereas a balloon is typically referred to something in the future, and present value, hence its name, is talking about what's the loan balance now. All right. Either way, it's calculated the same way. But let's go back to the example that I just gave, and let's put some numbers to this. So we already cleared the time value of money keys, and we said, let's just put in this, we said it was a 30-year amortization, right? So we already know that 30-year amortization would mean 360 payments. We said the interest rate is 6%. We also said that we purchased it some years ago, or 9 years ago, for $30,000. So that means the present value at that time was $30,000. 30,000 and principal value. Now, obviously, if there's anything that a person would know about their mortgage, is they would know what the payment is, right? Especially after paying it for 9 years. But just so we can keep ourselves consistent here, if you wanted to know what the payment would be for that, you would hit compute, and you would hit payment, and there you go. $179.87. Obviously, this does not include taxes and insurance. This is just principal and interest. Okay, so I just wanted to at least lay that foundation there. Okay, so now, well, by the way, if this were in a real scenario like this, if a person was, this is 9 years later after they purchased a house for $30,000, they may or may not actually remember what their original loan balance was. Some people remember what they paid for the house, but what you paid for the house and what the loan balance is can be two different things, right? Because remember you probably put a down payment, and the down payment isn't necessarily factored into your loan balance. For instance, if it was a $100,000 house, you purchased a house for $100,000, you put $5,000 down. That doesn't mean you started off with a $100,000 loan just because you bought it for $100,000. You bought the house for $100,000. You put down $5,000. Your loan balance was $95,000. So some people may or may not remember that. One of the ways you can find that out, if you needed to go back to the loan balance, original loan balance, is this is public record. So you can find that through whatever your county is, wherever the county is or parish where your house is located. They usually have something on public record. Typically nowadays they have this online. For Georgia, which is where I live, there's a site called gsccca.org. That's GSCCCA. There's so many C's. I think it stands for Georgia Superior Court Clerks Cooperative Authority. I can't believe I made it through all that. But that shows you like deeds. It shows you mortgage notes. Shows you all sorts of different things. Okay. There is a subscription for that, so you have to pay for that. Okay. So let's go back to the question. The question is, so if you purchased this house for $30,000, 9 years later, 9 years later, what's your principal balance now? Okay, so here's what we need to understand. Remember we said that the 9 years have passed, right? So if 9 years have passed, then that means those 9 years shouldn't be reflected in our calculation. We want to know how much time is remaining on our loan balance, right? So let's do the math here. So if 9 years, remember we said duration is always entered in months, right? So 9 times 12 is 108. Okay, so we already know we started off with a 30-year loan, which was 360 months. So in order for us to calculate what the new principal balance is today after 9 years, we got to figure out how much time is left duration-wise. Great. So we need to subtract. We need to take 360 months, which was the 30 years, minus 108, which was the 9 years, and we come up with 252 is the duration. So we plug 252 into the duration, right? And now we go back and we hit compute principal value. Now the answer is $25,737.05. Isn't that cool? So what that says in a nutshell is if you bought this thing 30 years ago, you've been paying on it for 9 years, payments of $179.87 or whatever that was, that means after 9 years, currently, your loan balance is $25,737.05. That's one way of saying that. Another way of saying that is remember we talked about the balloon. If you if you had bought a house from a seller and they gave you the ability to amortize it over 30 years, but they said, hey, I'm not going to let you pay me for 30 years. I want to be paid off after 9 years, give you a 9-year balloon. So this is another way of saying after 9 years, you would owe the seller on that $30,000 note, you would owe the seller now $25,737.05, all cash. That's how much would be due in one lump sum. Okay, so the difference between the balloon and this case and just your current loan balance is the balloon right now would actually be due. All of this $25,737.05 would be due right now because they want to be paid off. Whereas today, just the principal, present value, that's just showing you what your loan balance is. You don't have to pay it. It's just showing you where you are in the grand scheme of things. Hopefully that makes sense. Okay, so that's pretty powerful. Let's see, was any other thing that I wanted you to see here? I don't think I want to get too deep in this because this is some of our first sessions. Just want to show you the basics of using some of the calculator. But one thing that should hit you is how powerful interest is, and this is the reason why you want to be a bank. Think about this. And even in this example, you started off with a $30,000 loan, right? You've been paying it for 9 years. And even after 9 years of paying on a $30,000 loan, you still haven't made a $5,000 dent into it. Let that sink in. You still owe almost $26,000. That means you haven't even made a $5,000 dent into it, because one of the things you learned in interest reduction that we covered is that interest is front-loaded. In other words, most of the payment that you're making in the beginning isn't even to go to pay the principal down. It's going to pay the bank their profit. This is the reason why you want to be the bank. I can't remember who said it, but one of my friends said that one of the ways you can tell who's wealthiest is judging by the person who has the most people owing them, right? The more people you have owing you, chances are the wealthier you are. And by contrast, the reason why most people are poor is because they owe more people than they have people owing them. So your goal is to get out there and get someone to owe you money, okay, by getting real estate. Go get some real estate so some people can owe you rent. Go owner finance some properties so some people can owe you notes, mortgage notes. That's the goal, right? Cool. So that's a powerful lesson there. So here's your homework assignment. Remember the simple mortgage that we started with? The one where it was just, let me clear the screen here again. All right, so remember the simple mortgage that we started with. Let me go back here again. We started with the 120. Hold on, let me make sure I cleared my TVM. Remember this simple mortgage we started with, the 10-year mortgage at 10% interest with $10,000 as the principal value, and when you computed it, it was $132.15. Remember that template that we talked about? Here's your homework assignment. What I want you to calculate and then email it to me. I sense that most of you guys are watching these things but not doing your homework assignments. Rarely do I think I get a homework assignment from anyone. But what I want you to tell me is, tell me if the seller financed you for 10 years with a balloon due at the end of 6 years, what is your answer? What is the balloon that's due? Okay. In other words, there's a 10-year amortization. They're willing to finance you for 10 years, but they want to be paid off after 6, means you have a 6-year balloon. Tell me what that principal balance is. That's your homework assignment, and email it to me. All right, so that's going to help you this is a good first session. Shows you some basics, how to use the calculator. It tells you, how to enter information in the calculator, clear out any errors. We went through that. If some of your numbers aren't adding up, it tells you how, some calculators, that's one of the things I wanted to say, is some calculators, like in my calculator here, in order for me to compute, you notice I had to hit compute and then payment. Okay, some calculators like the HP 12C, I think of Hewlett-Packard, instead of hitting a separate compute button, you could actually just hit the payment and it'll calculate it for you because it's the one that's unsolved for. So that's some little variation from calculator to calculator. But hopefully that's made sense. So next week, what we're going to cover is we're going to go more in depth about something called discounting. Discounting is pretty powerful. It's pretty powerful. It's probably the most important financial lesson you'll ever learn about discounting. And the reason why I say this is because most people are always taught that it's best to It's best to always boost your income. What I'll tell you is better than boosting your income, because boosting your income creates taxes, right? It creates a taxable event. It's better to figure out how to stop a dollar from exiting you, right? If there's any place where you can see how to curtail some of those costs, then that's better. Discounting shows, I'm trying to figure the best way to explain this. Discounting shows you the power of what really goes on with mortgages. So what I'll leave you with before we get to that next session is, here's something to contemplate. What interest are you paying on your mortgage? And do you really know? See, most people go by what's stated on the documents or what they saw at the closing table, but once we cover discounting mortgages next week, you're going to realize that what you're paying in interest might not be what's stated on the paper. It's pretty powerful, and if you're ever presented with an opportunity to discount, well, you might want to take it. And I'm going to show you the benefits from the homeowner standpoint. I'm going to show you the benefits from the mortgage company standpoint. But discounted notes is a big deal, okay? So I think that's enough for us to cover this week. And so see you next week. All this stuff will be recorded and in your back office on Google Drive. And hopefully give me some feedback. Talk to you soon.